The market is jittery and Bank of America gets some good news. You're in the right place, folks, because this is where the money is. Welcome to the show, folks. It is Monday. I'm Matt Koppenheffer. This here is David Hanson. And David, you're 84% today.
Not feeling great.
Did you
not hungover for all you wondering. It's not.
Did you bet on the Broncos? Is that the problem?
I did not, but I did pick them. I will say my pick was completely wrong, but Demaryius Thomas did set the Super Bowl record for catches. So you give me some credit there. I said he would have a good game.
I'm still saying that you're wrong, but nice try. It kind of continues your streak. We like you as a financial stock picker. Next football season, we'll bring somebody else.
We did get an email that said, David's picking the Broncos, so I literally put $100 on the Seahawks, so congratulations.
There you go. All right, let's get... Oh, before we get to the headlines, reminder that we're coming up fast on the 100th episode. The competition is still going on. You can find us on Twitter at TMF Financials, email us, WTMI@fool.com, or you can find us on Facebook, Motley Fool Financial Services. Tell us why you like Where the Money Is, and you have a chance of winning a special limited edition Where the Money Is sweatshirt.
Sounds good.
And now the headlines. First headline of the day, we've got the Wall Street Journal, stock investors brace for a bumpy ride. David, apparently fund managers are moving away from the things that worked well last year because they want things that are safer. They want treasuries. They want gold. They want big companies paying dividends. Is this where you're going in 2014?
It's possible.
I have a feeling I know what your answer is going to be here.
Maybe. I don't think it's a bad idea for fund managers to go where they see value. If they don't think small caps are a good value and offer good returns over the next decade, 5 years, then don't be in them. But if you're going to move around and jump from small caps to large caps to treasuries, wherever, I would say just maintain a consistent process. Don't deviate from your process and going over to those things. If you want good companies, look for those same good companies in large caps. Don't just say, well, everyone's going to large caps with big dividends. That's what I'm going to do. Stick with your process and go where you see value. There
are two things that jumped out at me from this article. One was that large cap, small cap division that you're talking about. And the fact is that small cap stocks, small cap indexes have outperformed large caps for a long time now. And that happens, but it also happens that large cap stocks end up outperforming small cap stocks for stretches as well. Now this is a little bit of macro market kind of stuff, but the fact is that when you look at the small cap universe, stocks are expensive, and we don't want to turn away great companies just because they may look not at a bargain basement price. However, when you can't find small cap stocks at reasonable prices, then it makes it tougher to buy. The other thing that jumped out to me is that one of the fund managers said that 2014 may end in gains, but it's going to be a hard year. Now here's the thing. All the time, investing is hard. When you're trying to beat the market, all the time, investing is hard. And if you ignore that, I think you're just going to get yourself into trouble. Trying to find companies that are great and that are at reasonable prices, and then having the behavioral wherewithal, the zen, the comfort of owning companies for a long time to be able to stick with these investments, that's all hard. And it's all hard all the time.
Right. I think long term, beating the market is very hard. Short term, it's easy. I mean, you could have been, any investor could have picked a handful of stocks in 2013 and done really well. So if you're looking at this market drop to start the year, maybe it's a little bit of a humbling experience.
But that's luck.
Yeah, there's a lot of luck involved. Long term, you have to maintain your process, find good companies, and hold them. So, yes, stick with what you're good at.
Second headline. Finally, some good news from Bank of America, right?
Is it? Fine. Judge partially approves $8.5 billion pact between Bank of America and investors. Now, this was the pact that was originally agreed upon in summer of 2011. Bank of New York Mellon served as the trustee for a bunch of private investors, and they settled with Bank of America. And this was to say, was it reasonable? Did they act in good faith? Did they make a good settlement for all the investors? And the judge said, kind of. Mostly, yes. There was one part where the judge said Bank of New York Mellon acted in an unreasonable way, and they did not investigate some of the investors' claims that they need to look into some loans that were modified rather than loans that were just made in a very bad way and misrepresented. So most of the settlement is approved, but there is this tiny piece that is not.
So you're not thinking this is good news?
It's kind of good
I'm
news.
thinking it's good news.
It's more good news than bad news.
Okay. And yet the stock was down on Friday.
It was down. I think that's a little bit of a perfect example. We talked about on Friday mortgage REITs. You can't wait 2 years for them to have, okay, everything looks good, now you buy mortgage REITs. You've seen that with Bank of America. You can't wait till these things to happen. If you would have waited 2 years ago and said, man, well, I'm just going to wait to see if this gets approved ultimately, you've seen the multiple at Bank of America almost double since that time from a price to tangible book perspective in a time where it was still in a state of limbo. So you can't try to time these things.
This is baked in.
Exactly.
Yeah.
So
like a delicious cake.
Very
baked
delicious.
In like,
$8.5 billion cake.
Maybe I didn't have enough breakfast. Did you have breakfast? Maybe that's why you're 84%.
I did have breakfast, yes, always, most important.
All right, third headline of the day. We're going to the dividend tip sheet where the payouts are growing the fastest. This is from Bloomberg. David, you threw this one in on me at the last minute. So tell me what's great about this.
This was interesting because I think they had 20, 25 companies where they project, or analysts project, dividend payouts to grow the most. And the top 5 companies were all financials, and we're a financial show, so they're giving us some love. And the top 5 were Discover, Progressive, SunTrust, Regions, and Citigroup. So those top 3, SunTrust, Regions, and Citigroup, all have something in common. They did not fare too well during the financial crisis. Their dividends are very, very low right now, so those payouts have a lot of room to grow as opposed to some of these companies like a Procter & Gamble that are already paying out a lot of their earnings.
Now here's my question to you, and not to throw you under the bus here, but I'm going to throw you under the bus. When you picked the Broncos to win the Super Bowl, you got people betting on the Seahawks. Now you've got Wall Street analysts here picking these as the biggest dividend growers. Is that reason to bet on them or bet against them?
I wouldn't blindly bet for them. I think there's some interesting points here, how we talked about how consensus is still not great around investing in banks. And we talk about it and we think it's getting better, but
we think it's wonderful.
But most people want to stay away from banks. Oh, well, they pay 1 cent dividend. I don't want anything to do with that. This will just be another kind of thing that pushes people towards financial stocks.
Yeah, I think the perception changes significantly when all of a sudden Citigroup is paying a reasonable dividend, Bank of America is paying a reasonable dividend. I think that would have a big impact on investor psyche, whether or not it's the best move for those banks. As we've talked about before, the capital planning process is coming up. We'll get the results of that in March, and maybe they'll be looking to raise their dividends. They'll probably be looking to get approved for share buybacks. And right now, particularly I would say for Citigroup, share buybacks may be the better route, but from an investor feel-goodiness kind of standpoint, maybe the dividend's a better call.
Perhaps.
All right, we're going to move on to the focus for today. And the focus is on, this is so exciting. This is the Office of the Comptroller of the Currency, the OCC.
Yes.
One of the key bank regulators, and this is the Survey of Credit Underwriting Practices.
Woo!
Yeah, right. It doesn't get more exciting than this. This is looking at 86 banks with assets of $3 billion or more, and basically this is the regulators, the examiners, checking out these banks, talking to the lenders, and trying to figure out where lending standards are going, and whether they're tightening standards, whether they're loosening standards. This is a great indicator for us and for bank investors to say, well, are things really still pretty tight out there? Are banks really still hanging on to their money, or are things loosening up? And right off, I'll kick it off by saying one of the things that I thought was a little bit interesting was that when it comes to commercial lending, in terms of bankers giving reasons for tightening or loosening standards, the economic outlook was cited as reasons for both, in basically equal portions. So they were saying we're loosening standards because of the economic outlook, and then others were saying we're tightening standards because of the economic outlook. So I think once again we've got a sign here that when it comes to the broad economy, nobody really knows what's going on.
Right. In terms of the large corporate, so commercial looking at business loans, large corporate, they saw a lot of easing there. It's basically banks saying, please borrow from us. But the corporate clients have so much cash sitting on the bank's balance sheet,
so much cash.
And they say, well, we're fine. We have all this cash. Why do we need to take out loans?
What's Apple need from a bank right now?
Exactly. So it was interesting. There are some areas that they say they saw easing with indirect consumer, auto loans, I think is probably the big driver behind that, credit cards, and then the large corporate there. So those are areas that it's starting to get a little bit easier Whether you think that's a good thing or a bad thing, it's kind of up in the air. I like to think about easing standard and lending standards as a pendulum. We usually sway way too far to the one end where we give credit to everybody and it doesn't matter. And then, like we saw in 2009, swung way too far back where nobody's lending at all. And you can see that they have charts from 2009. Basically, 0% of people said that we are easing standards. That's obviously not what we want quite there. So we're never going to be right in the sweet spot. It's going to be very few and far between. But that's where we want to get. It looks like we're getting a little bit closer to the center, still maybe on the tight side.
Exactly, and I think that's a good explanation that you're using with the pendulum. And what we're going to want to watch for is what happens when the pendulum starts to swing too far again. Based on this survey, I still think, and it's not a question of if it will swing too far.
Right.
It's when does it swing, at what point does it swing too far. And based on this survey, I think we're still in the early part of the swing, in the early innings, if we want to switch it to a baseball metaphor. But as that goes forward, we'll want to keep an eye on it. And when I talk about wanting to own banks like Citigroup, for example, that did not fare well at all through the last down credit cycle. At that point, when you start to see so much loosening going on, credit standards getting a little too far out of whack, that's the point where the rubber really meets the road, and you've got to say to yourself, is this a bank? And this goes to Citigroup. This could go to Regions Financial too, which you just mentioned before. A lot of the banks that didn't perform well last cycle, at that point you got to look at them and say, have they really changed in terms of the way that they're doing things? Because if they haven't, you don't want to own them at that point.
Right.
At that point, you want to be just with the best of breed, with the guys who are analyzing risk right. The reason that I would recommend a stock like Citigroup, a company like Citigroup, let's say, is because I think things are changing. And I think under Mike O'Neill and Mike Corbat, they're getting back to basics, doing better banking. But I want to be sure of that before the next credit cycle comes around.
I'm sure all of our listeners are out there rushing to their computers to read this report right now, maybe. But I would say that you should
There's a lot of pictures in it.
You should take these with a little bit of a grain of salt, in my opinion, because these aren't going to come out and be a glaring red sign that says, credit's gone too far, there's about to be a recession and a crisis. I don't think that's going to happen.
I don't know. I don't know
I don't know if they're exact predictors, especially when you look at one sentence said, the survey indicates that 70% of responses expect the overall level of credit risk to remain unchanged or increase over the next 12 months. So basically no one can even envision anything bad happening. Everything's going to be the same or get better. So it's possible that things can still happen to knock this off.
Now, one area that I will point out as being just a little bit worrisome to me, maybe worrisome is overstepping it at this point, but credit cards, you mentioned. It looks like there's a lot of easing going on with credit cards. And we've talked a couple times in this show about how credit card lending looks like a great place to be right now because you're still getting spread in a world where interest rates are so low that the spread between what banks can lend on real estate loans, for instance, and what their funding cost is, that's very thin. But when you think about what they're getting on credit card loans versus what their funding cost is, and then even when you take into account the credit costs, the higher credit costs of lending on credit cards, you still get a ton of income there. And part of that is because credit has been, we haven't seen the big downturn, the big, huge charge-offs on credit card portfolios that I think were expected. So we got a lot of lenders getting in there. And one that I'll be keeping an eye on, which would be kind of interesting, is it seemed like Bank of America had kind of slowed down its charge into credit cards.
Yep.
And we had kind of seen Bank of America slow down its charge into the mortgage market. And then when rates were low, when everybody was making tons of money on refinancing, Bank of America came back in late.
Right.
And when it comes to the credit cards here, at least for the lenders, and again, let's not get Visa and MasterCard confused here because they just provide the processing. Yeah. They're not the lenders. So when it comes to the lenders, I want to see if Bank of America is able to handle this well or whether they're charging into the game late again.
Very interesting.
All right, we're going to go on to the mailbag. We have an email address. It's wtmi@fool.com. Send us an email. We love emails. There's nothing that we like more than emails. And with you at 84%, was it 84 or 87%?
It's going down to 82%.
Whoa. And with David at 82%,
Crumbling.
We need all the emails we can get today. Our question for the day comes from Zen. Zen writes, if you were offered the following three things, 5,000 Rembini, an unlocked iPhone 5S 32 gigabit, or 1 Bitcoin, and you get to keep one, but with the catch that you must hold on to it and not sell it or trade it for at least 3 years. Which one would you pick?
I don't know the conversion from the Chinese currency, full disclosure. I should have looked that up. Do you know what it is?
I should have looked it up as well.
So, I'm sorry.
I'm assuming they're on a like-to-like basis. Let's assume that they're on a like-to-like basis. So
Okay.
Bitcoin is $800 to $1,000, we'll call it. The iPhone, let's call it the same. And so which
You got to hold it
of
for 3 years?
3 years.
I'm going to go with the iPhone. I think that's the safest bet.
Really?
I think it is. You got the hardware in there, the chips. Technology will change, but I think you still got some valuable things in there. I don't know, with Bitcoin, I just don't know if the value will be there. I think the service will still be there, but I feel safer holding the physical iPhone. What do you think?
Whew. I'm going to go with the Bitcoin.
Okay.
And again, we've been through this kind of exercise before, and I don't want this to make me sound like some kind of crazy Bitcoin bull, because I'm not. I think it's an interesting technology, and I don't think of it as a currency. I think of it more as a way of exchanging value. The Chinese currency, I don't know. I don't know anything about it.
Circle of competence,
yeah,
not
exactly.
in yours.
The iPhone, that's just going to lose value. You're losing value there. You're guaranteed. Technology moves so fast. Next year, there's going to be some exciting new iPhone, and your iPhone that you're hanging on to is going to be worth less. So I'm going with the Bitcoin.
All right. That's fair.
All right, moving on to our game for today. We have a little graded.
Making the grade. He always gets that wrong.
I always get it wrong. I don't pay attention to those details. Making the grade.
Yes.
So we're going to present a few scenarios here, and for each of the scenarios, we are going to draw up our beautiful artistic rendering of what we think about that scenario. First scenario, David, we've got the approval of the Bank of America settlement. So Bank of America has been given approval for most of the $8.5 billion settlement over private mortgage securities. And what should investors be taking?
This is a little weird.
That is, I don't even know.
This is that's a Bank of America investor, and they were biting their nails because, like we said earlier in the show, this could really only go badly for them if it would have been completely shot down by the judge there. So the valuation had already creeped up, had already kind of leaned towards the way that it would get approved when you look at it trading well above tangible book value now. It wasn't, the market wasn't anticipating a huge hit to Bank of America's bottom line here. So if it would have been completely thrown back to the drawing board, maybe that would have been an issue. I know some people had the estimates, maybe it creeps up to $30, $40 billion instead of 8.5. So they were biting their fingernails. It's all good now.
All right, got my little cartoon guy here, and he's shrugging. He's shrugging. He's saying, meh. It's like we said earlier in the show, the settlement here, I think, was baked in to the price already. I think there was every expectation that this was going to get approved, and I think we got that. And the part that wasn't approved, I think, was more of a disappointment than adding to the excitement because of the expectations of this getting approved. So I think for Bank of America shareholders, what the real outcome was avoiding a big hit if it wasn't approved.
Yep.
Second scenario. We've got KKR opening its first Spain office. This is the hedge fund giant, or the private equity giant, opening up in Spain.
Giving that an A+, going traditional here, that's an A+ by KKR there. Spain, if you mention that to anybody, they say, I'm never touching that economy. Unemployment of people under 25 is something 50%. Overall unemployment, 25%. Why would anyone go there? They're going where the opportunity is. They must see value there. And hey, I lived in Barcelona for a little bit. That is a nice place. Spain is a nice country, temperate climate. That's an A+.
You know what that is?
Dollars.
That's a whole lot of dollar signs. And if I had more time, I probably would have drawn more dollar signs. KKR knows where the money is. They're going after where the money is. That's the name of our show. They're going after it there. I think like you said, a lot of investors are avoiding Spain because of concerns over the macro economy, and KKR is getting away from that, and that's potentially a big winner for them. Moving on to our third and final scenario, we've got making the grade Peyton Manning's legacy.
We couldn't leave it all to Stephen A. Smith and Skip Bayless. We had to
exactly.
All right, so this is an interesting one here. Here's my scenario here. This is Peyton Manning's little timeline and his legacy there. It's been going up, had a few bumps in the road. This is right now, not great in the legacy, dipping down, but as time goes on, I think we'll start to realize that he was pretty darn good. We do that in society. As people kind of stay out of the limelight as they're retired, we hold them in higher light. So he'll be fine in the long run, I think. What is that? What do you got there?
This is a before and after. That's a football. That's a deflated football. That's what his legacy looks like right now. That was, I mean, it's not all on Peyton what happened last night, but that was awful. That was hard to watch. As one of my friends tweeted on Twitter last night, he wanted to anxiety puke for Peyton Manning, and I couldn't agree more. Watching that game, watching that first play, I think it was just so painful. I think you're right. I think with time it'll come back. That football will.
Hey, John Elway lost 3 Super Bowls. Let's remember that. And everyone thinks he's amazing. So.
I mean, Joe Namath, I mean, he's wearing that coat that he wore last night and somehow holding on to his legacy.
His legacy just plummeted.
His must be ironclad if he thinks he can go out in that coat and be okay. All right, let's finish off the day in the Twitter sphere. David, what's our first tweet?
Our first and last tweet is from Neil Irwin, the great economics writer. He says, well, that was fast. Bernanke joins Brookings effective today as distinguished fellow in residence. Must be nice. I mean, Janet Yellen gets sworn in and you leave and you get a new job waiting for you. Not bad.
Do you think that's surprising? Do you think he had to submit a resume?
It's not surprising, but it's just must be nice.
If I were Ben Bernanke, my resume would look like this.
I was Fed chair. Fed chief, even better.
Fed chief. I would just give them this. It would be handwritten. I wouldn't even put it on a computer. I would just be like, here's my resume.
How much more is Ben Bernanke making now as opposed to when he was in office?
Is it enough for me to say considerably?
That's enough.
Considerably more?
He's going to be okay. I think he can finally upgrade from that Ford Focus.
Is that what he's driving?
That's what the reports were.
Are you continuing the brutal advertisements for Ford that we saw last night?
That's what they should have done. They should have had Ben Bernanke upgrade.
Who sells cars better than
Everybody knows who Ben Bernanke is on the national stage.
Oh, man. Absolutely. Well, that's the show for today. As always, the show brought to the WTMIers by the Motley Fool. Email WTMIoffer@fool.com to get a special free report. This details some of Warren Buffett's greatest wisdom. We can be found on Twitter @TMF Financials. We can be found on Facebook, Motley Fool Financial Services. I'm Matt Koppenheffer. This over here is David Hanson. We will see you tomorrow.
People on the show may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. Don't buy or sell stocks based solely on what you hear.